it seems like we're live. Okay, so people can hear us, hopefully see us on YouTube. I've got to say, like, I got the Starlink delivered, and it's just not in time because it's horrible weather here in Victoria, or at least where I am today. And so if I happen to cut out, I don't have a redundancy. So we'll find out what happens. But anyway, mate, welcome to the show. How you going?
Good, mate. How are you?
Yeah, pretty good. Pretty good. It was the first full week of reopening here, so in Vic. So really excited. And today we get more privileges, being Friday, the 29th of October. We apparently I just heard from Kate Campbell, my co-host on the finance podcast, that from tonight onwards we can actually walk around Victoria without a mask outside. So that's really nice. Do you have those privileges? I feel like you do.
Yeah, I don't know. You should just go bonkers and crazy and just try to find parking. Maybe you can't find parking. I think we can walk outside without masks. We still have to wear masks indoors, in indoor retail settings. I'll be honest, I have not visited a restaurant or a cafe yet.
Still, you haven't got a coffee yet?
I just make coffee at home, Nespresso.
You're a changed man. See what COVID does.
Yeah, like, I'm going to try to get a haircut, but that's really about it.
Okay, fair enough. And for some people, coming out of lockdown hasn't really changed that much, right? Because you and I have the privilege of working from home, basically whenever we want to, all the time. So it hasn't really changed from that respect. Working from home. I think there was a comment that I heard the other day, though. Some people are confused whether it's working from home or whether it's, the difference. You don't know the difference between if you're working in your study or if you're working in your bedroom. And I think people don't know the difference between that, and it can become unhealthy. So for some people, it's going to be great to get out of lockdown and back into an office. But vacancy rates are still really high. Anyway, what have you been working on this past week, mate? Yeah, we're coming up to the 1st of November.
Well, recommendations. Working on new rec for November. Mm-hmm. We had a team call. We discussed our recs. We had some fiery debates this time. So these team calls, for the team calls are going to be very interesting for those people who actually watch these things. It's going to be very interesting team call. Pretty fiery, strong debates this time, which is always exciting. I love those. When there's this difference in opinion, and somebody thinks it's really a bad rec, and somebody thinks it's really a good rec, right? And that variant perceptions, really works really well.
But when someone does get really fired up or really animated with someone else's recommendation, what are the kind of questions or points of view that they share? Is it just they think with their domain expertise, they don't think that sector or that theme is worth, or it's going to shake out differently?
So sometimes what happens is let's say I'll try to give an example without really giving out anything. So let's say I pick a SaaS company, right? And there are a number of people in the team who have SaaS competencies, right? So I might pick a SaaS company, and Simon might have something to say about that because he has probably looked into it, or Steve might have something to say about that because he has looked into it, or even Matt Cochrane has looked into it and he has something to say about it, right? And there might be something that I might have missed, or there might be different interpretation. Even it's not a question of missing it, right? Often you can interpret the same thing differently, right? So we might talk about this, or we might not. Like, we were having a debate on our Slack channels internally, and so Facebook Metaverse, like, you could spin it positively, you can spin it negatively. You could be ambivalent towards it. And there's so many different ways to look at the same thing, right? And it's just interesting. I find it interesting that we can have these different opinions. And then, people generally don't change their view, right? But you can temper your view a little bit. And I find that useful. If you have a position, or if you want to have a position in a company, that's, I think, a useful thing to have. Also, it's useful to have this belief and understanding of what is going on and how you think things might shape out. If you have positions, if you're interested in the general area, right? So I might not hold Facebook, but I'm generally interested in that whole area. I'm not whether it's ad tech or ads or games or, augmented reality or virtual reality. I'm interested in that space because that space is huge, right? And there are many companies in that space that might be worth thinking about. So it's just a good thing to talk about because you learn something. And sometimes you hear about opinions and, things, and that, I'm a very big believer in understanding how individuals are thinking about company. And the reason I find that interesting is, and that's why I find Twitter very interesting, is it tells you how a bunch of investors are thinking in a way that you can't otherwise get, and that behavioral psychology can sometimes be actually very useful. Right? It's useful when there's the strong variant perception or strong bearish, bullish, comments. Then you can actually use it to your advantage if you think you have an edge, right? Again, it might not work out, but again, I think it's investing is not just science, right? It's not science at all. It's an art form in many ways, and understanding behavior is a part of that.
This is a totally different. This is a left of field example, but how it relates is quite interesting. Kate and I, on the other podcast channel, we were talking about how there was a blog and a survey done by the CFA Institute, and it basically showed that the way we interact with money from the ages of about, I think it's about 14 up to 21 or thereabouts, are actually the most formative for how we later on invest and how we think about investing money. Morgan Housel did something similar when he did that Microcap Club conference where he talked about what other industries teach us about investing. He said that if you grew up in the 70s with high inflation in the 80s, you would invest in bonds and those types of things. If you grew up in the Depression era, you'd just have your money in cash. And if you grew up in the 90s, you'd have your money in stocks. And so I think, the environment in which we kind of analyze investments is what makes the market, right? So it's a bit of nature, a bit of nurture perhaps, but I think the environment and how those tools that we're given in our philosophy really is where the art of investing comes in. And I find that is really the case with the new technologies and thematic investing, because what we see, our truth is different to what someone else's truth could be. And so that it's actually fascinating. Like, we can have two different opinions, but at the end of the day, oftentimes it doesn't matter what we think, it actually matters what happens. And I think you mentioned mental models and kind of trying to get to the bottom of that. I think debating it with someone is really, really positive, and also just inverting it yourself if you don't have someone to debate it with. So what could go wrong? What sucks? What's the downside, basically? I think that's a great tendency a common tendency amongst great investors.
Yeah. I totally agree with that. I think the only caveat I have is that you want to debate, but you don't want to talk yourself out of everything. It's very easy to talk yourself out of everything, right? So,
and a lot of investors do that. Yeah,
a lot of because bear points are easy to come up with, right? But the question is, are those really the valid bear points? And again, this is like, this comes with experience, and it's exactly what you're saying, right? It comes with experience. It comes with your point of view, and those examples that you gave, right? In my time frame, what you saw, your perspective is going to define that, right? So it's cool, very cool.
Yeah, I spoke to during the week. I spoke to an investor by the name of Julia Forrest, and she's a REIT investor and property investor. And she's actually appearing on the Australian Investors podcast next Wednesday. And she basically came into the industry in the early 90s here in Australia when there was the recession that we had to have. And that's basically stuck with her the whole time. And so now she acknowledges that she invests in a very conservative way. And the only thing that she can think of is that it's the legacy of her initial introduction to investing into the industry. And so, those things stay with us. And that then when you have debates, someone's looking at it through that lens, and then I look at it through my lens, whereas I started my career with the Motley Fool, and it was all very positive, invest in great companies, we're in a bull market. So my first interaction with investing is actually very positive and very long-term optimistic. And I think that's, if I was to debate with someone like Julia, that would probably be a very different conversation. But interesting, always interesting. Okay, if people want to ask their questions, we've got a heap of questions and topics coming through Twitter today. Fascinating stuff. we'll try and get to some of those things, but we already have our plate full with US tech. One of our favorite companies, which is Apple, reported some results, and that was just this morning as we record this here in Australia. So we'll get into those. We've got Alphabet, we've got Facebook/Meta, which is fascinating. We've got some Australian companies in here too. If you want to ask your questions, you can throw them into the YouTube live chat on the Rask Australia YouTube page. There was one question that came through in advance, mate, and I thought maybe we can just really quickly riff on this one. And it comes from Charles, who says, "Great podcast, thank you. Have you or could you discuss your favorite tools of the trade to source data, charts, / do research, trade, whatever, both domestic and international? Your insights would be appreciated." So I don't know if there are any just off the top of your head, we get information, if you use data, whatever. I know Seven Investing include a little data pack when they give out when you guys give out recommendations, which I think is great too.
So I use this. I think you've mentioned this before in the podcast. I use Ticker, TIKR. They provide data. They provide access to transcripts. So I mean that's they have insider holdings information. They have holdings of various funds. So that's one tool that I use. I use Y charts as well. Sometimes they have beautiful data and charting. Y charts is, I believe, mostly US. Actually, I don't think I've seen any ASX or anything else there. It's US only. I can't remember it. Yeah. I think it's US only. Whereas Ticker has everything. I think it's got ASX and stuff like that in it as well. Other than that, really, my other source is my iPhone's stock app, because that links to various articles, and that it's a very quick way to see what's going on. Like people have an opinion, somebody wrote an article, something got published in news media. You can very quickly have a browse to see what's going on. You don't have to believe it as the truth, but you can at least have a look. So that's something that I do. What else is there? And then of course, if I need to look at something, I go to the information source. So investor relations web pages are the place to go to. So, if I'm looking at a US company for quarterly results, I'll look at 10Q. If I'm looking at annual results, I'll look at the 10K. If not, the press release, the slide deck provided by the company. Those are sort of my basic toolkit things. I'm not, I'll say this might sound odd. There's no magical tool out there that gives out good ideas. There's no magical tool out there that gives out. There's this thinking that a lot of data is useful. Actually, a lot of data is not necessarily useful because you're just going to be confused, right? There are these tools that you can get to get return on invested capital, this, that, PE, and so on and so forth. All that stuff is actually not very useful in my, everyone starts there, I think, but sooner or later you realize that you need to make decisions more qualitatively than quantitatively, right? And if you want to make quantitative decisions, I find just simple run of the back of the envelope stuff is better and easier, less mistakes. I like to quote George Box, all models are wrong, but only some models are useful. So you want to make the models useful, not necessarily accurate. Because by definition, models make assumptions, right? So, anyway, that's what I do.
Yeah, and we've talked a little bit about the qualitative side of investing versus quantitative in the past. So it's a great question and great talking points and a good answer from you, mate. I use Ticker. I probably use it. That's probably my primary data source. And in Australia, if you want announcements, you can go to something like Market Index, which is powered by Iguana. So you can just go down to the announcements section there, which is really helpful. And if you're in the US, you can get on CNBC or Bloomberg. It's actually a great thing. I do like to do it in the mornings, like if I'm doing a morning stretch or something. I might put on Bloomberg on my smart TV. There's a Bloomberg Live app in the marketplace that you can get. It's free. It's all the Bloomberg information coming out of the US and global markets. I think by the time you get up here in Australia, you get the back end of the US markets, you get the tech show, and then you get the start of the Asia Pacific and some leftovers from the UK. So it's really interesting for a global perspective. There's lots to go on there. Great question from Charles. You can write into us if you want. You can hit us up on Twitter, which is @7A Mahanti and @Owen Rask. You can find us on Twitter. We love talking about everything to do with investing. So find us on Twitter and say g'day. So we've got a lot to talk about today. You brought up one of those things, which is Facebook's metaverse. Company came out and reported results this week. Maybe we can just riff on that a bit, because the Equity Force has written into us on YouTube here, and he says, will Facebook be in the biggest migration, be successful in the biggest migration of old millennials to metaverse? And the second question is, could you please talk about competition in meta, likes of Decentraland, etc.? So yeah, it's a big thing. This metaverse shift from Facebook came out yesterday, basically saying that Facebook is going to be rebranded as Meta. So this is the corporate business, similar to how Google's parent company changed to Alphabet. Facebook is now, under Mark Zuckerberg, focusing on the metaverse, which is basically, instead of just seeing the internet through a browser, you are in the internet, so to speak, and you can interact. You can buy clothes for yourself and your metaverse self. One of the things that I pulled out of the chat, mate, or the transcript from the Facebook call, was that this was the first time I think Facebook had put a number around what's probably possible in the metaverse. It's all very up in the air. As you said, it could go one way or the other. But one of the things that Mark Zuckerberg said is there would be hundreds of billions of dollars of daily commerce on the metaverse. And that's not to say advertising, but just general things that people will be doing. So I guess maybe if we can talk about, will Facebook be successful in your opinion, but also just to maybe intro it, what is the metaverse?
So right now, I don't actually know how to define metaverse, right? Because there is nothing of it that exists, right? Currently. So, you can think about people selling digital. Well, there's some version of that, right? So people buy digital goods on things like Roblox. There's apps inside apps. That's Roblox, an example. Minecraft is another example, right? So that's sort of the using a platform as sort of a venue to transact, do things, and create other experiences, right? So you can think of avatars. That's how I think about it, right? But to me, so I had a sarcastic tweet out today saying that voice was supposed to be the next platform, and it was not. Right? And voice was more well-defined at that time. Metaverse is very ill-defined at this time. And certainly to me, it doesn't look like it's going to be the next platform. So it could be that people are selling digital goods, and people are buying $100 JPEGs, $200 JPEGs.
Who knows? It could be a lot more expensive based on what we've seen recently.
Yeah. So it could be a lot of what I call rubbish out there to create sort of a different online world. And so, my take is that, let me answer this differently. Right now, I don't know what metaverse actually means. Maybe it's all in Zuckerberg's mind. All good. The other thing is that I really have a distaste for corporate rebranding, and I'll say why. So Google rebranded to Alphabet. What changed? Everything except for Google and YouTube is basically a failure in my mind. So Alphabet's other category basically doesn't exist. Right? You can call it whatever you want. You can call it alphabet, Greek letter soup, whatever you want to call it, chicken soup. It doesn't matter. It's still Google search ads, right? So my take on this is a very simple one. I think paradigm shift in how people do things is extremely hard. It's extremely hard. It's also a very iterative process, and it's very difficult to make that fundamental shift happen, which is why I think voice didn't happen, right? People have been at voice for a long time, and nobody's really figured it out as a platform to do stuff. So what did we land up with? We landed up with a bunch of speakers, which can either play music, some play good music, some play bad music, and they are good timers. So, our HomePods have a lot of timers on them, probably 1,000 of them. That's what they really do, right? So they're not a computing platform at all. And I feel like right now, the technology is not ripe enough, whether it's hardware, software, and to enable something else. So I think what they're gunning for is trying to be the next platform. And that's a very difficult gig to be in, right? So that's my take on what it means. And to me, it's basically a corporate rebranding, which is good for, which I think is the right thing to do for them. I think if I was Facebook, I would be doing these things, because it makes sense to do a corporate rebranding given that your brand has been tainted, shamed, and whatnot, right? So you rebrand yourself to something else that gives you a lot of buzz, and that's great. And maybe, you know, shareholders forget about it and move on, and then you continue tinkering with Oculus and virtual reality and everything else, and gaming and esports. But that doesn't become your business. Your business still is selling ads on those platforms, right? And getting people to come to those platforms to spend their time or waste their time, whatever, however you want to look at it, right? But that is the business. And that, I think, does not change. And I have seen nothing as proof of change. So that's my critical view of it, because, you know, I have not seen any product. I'm not saying product. And then the final thing is that a company that sells free, for it to sell something, if it needs a hardware element to it, to sell something at a premium price, which is because any new experience is going to be at a premium price. It's extremely hard, right? Selling how many Oculus headsets are they going to be able to sell? You know, because people are used to free from Facebook. They're not used to, you know, it reminds me of the Facebook, whatever console or stuff that we have forgotten about, right? Facebook had something that was like a camera and stuff like that. Before that, Facebook also had a phone, if people remember. So people, you know, so if this is hardware play, then I don't know what it is. And if it is a software play, I still don't know what it is. So that's my take. I think from a corporate point of view, it makes sense. For them to spend money, it makes sense. And this is, you know, although I said a lot of negative things, this doesn't take away anything from their free cash flow. It's a very free cash flow generative business. Continue generating those free cash flow. And, you know, they can miss 5 different things and they'll still be okay. Like Microsoft is a great example. So I think as a business, they're fine, but I am not buying the hype cycle of the metaverse or any other verse or whatever verse it is. I'm just not buying it. I've seen enough of these to say that, well, you know, show me something. No, but I'll take your take on this.
Yeah. So it's interesting, right? Because they're committing to investing $10 billion basically a year. That's what they're already at. And it looks like they're going to keep accelerating that spend, which is huge. But the thing that I guess is challenging, and the reason why so many of us don't know exactly where this goes, is that to become the platform of the metaverse, as I understand it, you would effectively have to have the hardware in place, but the infrastructure layer has to be there, and then everyone has to build onto that infrastructure layer and design apps, environments, etc. So there has to be protocols for that. And then you have to have someone or something that comes in as basically abstraction and sits on the top and designs things that people want to purchase. So for example, I think things like, you know, I think some of the most successful platform ecosystems over time, not all of them, but many of them are open source in this way. Like the internet in a way it's free to use the internet as it is. And you know, if we look at, say, I don't know, maybe like an ecosystem like, say, WordPress, that's the way that was successful was by allowing open source as the underlying architecture and then building on top of that. And so I think maybe, I just don't know. I don't think we know enough about how Facebook sees that playing out in terms of where do they sit in that layer and how do they monetize that really effectively. They said it's going to be in the back half of the decade where there's a business case. And, you know, for example, if you have an avatar version of yourself in the metaverse, I can't imagine that, I can't understand why it should cost you to put a different skin on your character, for example. Whereas, say, in gaming as we know it today, where typically, let's say you play Call of Duty or one of these multiplayer games online, typically the way those are monetized is through microtransactions, where you get a better skin, you get a look and feel of your character. So I don't think that necessarily is the way we should be thinking about it. I just don't know, to be honest. Virtuoso Consulting on YouTube said, the bigger worry is what should we call Fang now? Top choices are Magma, Gamma, Mama, or if maybe we can rename Google too. So that's really interesting. Yeah, and just in terms of, Facebook being successful with millennials, I think it's been a challenge for the company over the last few years. Even as kind of Instagram ages out, I don't know what takes the shape, whether that's people meeting online, talking like younger people meeting online in games and virtual environments and communicating that way. I think the days of you looking down at your phone and you're jumping on a social media app are probably, I think it's probably a bit dated for the younger demographic. So I think it'll be more immersive, that next experience. So Facebook may be there, but it may not be there. And then, like you said, they may miss this one. Anyway, we've got a lot to talk about. That's Facebook changing to Meta.
I have a quick comment about that FANG, MANG, whatever is going on.
Oh, yeah,
So a couple of corrections on that. Number one, we should ignore the non-trillion dollar companies. So Netflix is out, Facebook is out, and we now need to think about those companies which have huge TAMs. So if you think about the companies with huge TAM with trillion-dollar market caps, then you can have a caption called TAM with a lot of A's in the middle. So yeah. Anyways, that was just a joke.
I like it. So Sam McDonald says Meta World Peace was already taken to Zucker's Digest. Ron Artest pipped me by about a decade. Okay, so we've got Apple to talk about too, mate. Apple came out this morning and released some results, quarterly report, fourth quarter. Basically, supply chain cost them about $6 billion, they estimate, but still massive, massive numbers from Apple. Just enormous numbers. I know we're a couple of fanboys for Apple, but huge numbers, huge numbers. First impressions?
9% growth, right?
Yeah,
and that's without the 6 billion.
Yeah, it's a small cap.
It's a small cap. It's small cap company, which was in some billions. And then what was the other thing? Oh, the EPS. I don't know if people saw this. Nobody actually. Apple never puts, out of shame, it never puts its EPS growth numbers. I just calculated. It was like 65% for the quarter.
Oh, wow. Well, I didn't calculate it either, so I'm just looking at it now.
Because Apple never puts it in. Like, I don't know why they put it there. Like, Tim Cook is stupid. He should, come on. So, the little small cap called Apple just cooked 60% something growth. I think 0.74 was the EPS. It was like 1.3 something, or 1.24 was the EPS this quarter. I thought, I'll just say, I had only one word for the quarter. I thought it was fabulous. And this is a company that exactly knows what it is doing. And the reason nobody appreciates it is it doesn't talk about what it is doing behind the scene like some other companies, which talk about things that they haven't yet cooked, but they're going to cook in the next decade. Maybe not cook. This is a company that only tells you stuff that has fully cooked. It doesn't tell you what it is making in the next decade, because that, why talk about stuff that you've not yet built? It talks about stuff that it's building right now. So I thought it was a fabulous quarter. I'll let you go first. I have some, I'll let you go first. And then if I have some interesting, I think there was some interesting commentary in the call. So if you have your shares, and then if you don't cover them, I'll cover some of them.
Yeah, sure. So maybe I'll just jump into sharing my screen for those of you that are watching. This will make sense. Here we go. So just as a quick highlight from the financials, we can see total sales of $365 billion over the year. For the quarter, that's 83. Gross margin still incredibly strong, $152.8 billion gross margin. So insane. It was really, as you can see here, this is the diluted earnings per share of $5.61, up from $3.28 a year ago. And keep in mind, this is during COVID when they were still punching records. So really, really interesting. What I thought is really just, if you take your mind back to 2 years ago, 3 years ago, the China story was really uncertain. So I've just highlighted that here. $68 billion of full year revenue from China, up from 40 billion. Huge numbers in China. When you consider that market has still got such a long way to go as well. And finally, just as a high level, we're looking at services revenue down here. For the quarter, it was $18.3 billion, up from 14.5 a year ago. But over the full year, $68 billion of service revenue. Why is that important? Because the service revenue is oh so sticky, super wide margin. And that comes from all different things like App Store. And one of the big things that they called out in this quarter, which I thought was interesting because I can't remember them calling it out recently, was advertising. And so we've seen a big shift in the mix. Obviously, the iOS changes have come through. Facebook was actually kind of a victim of those changes. Google seemed to just pass that by. But one of the things that was really interesting was, they called that out today. They've got 745 I believe it's 745 million subscriptions, paid subscriptions, I think. So added 160 in a year, 160 million in 1 year. So that was probably my highlight, is just the ongoing growth in the services. This is nothing new for those investors that have been following it for a while. This transition's been happening for at least probably 4 or 5 years. But it's a huge business. Pay a dividend too if you're interested in that. It's pretty phenomenal at these valuations. But yeah, I thought it was just a tremendous quarter, even though we had that $6 billion. It looks like it's going to be a bit more painful in the next quarter, when obviously it's a big quarter for them coming up. So that was just a high level stuff. I'm interested. I didn't cover a lot from the call just now, so I'm interested in what you come up with.
Yes, a couple of things. So number one, for the forward guidance. So they're still calling for double-digit growth next quarter, which was on top. If you have to remember, it was on top of like some 40% growth the previous year in that same quarter, right? So this is like a big business becoming bigger. They're seeing very robust demand for their new products, and the issue is, it seems, is a supply side issue. That brings me to an interesting thing about what's going on with the supply chain. So there's a lot of supply chain, a lot of talk about chip shortages and things like that. So what, Tim Cook, being a supply chain genius he is, he basically talked about this. He basically said, look, we are seeing, actually they're seeing shortages, which is interesting. They're seeing shortages in not the leading edge chips, because they probably get priority on the leading edge chips because they probably pay more. So there's no shortage really on the leading edge side. There's shortage on sort of what's just behind that, and because there's a lot of competition for those chips. And what his take was that what happened during COVID, and this is an interesting take actually on entire COVID economy, and what happened with companies. And we've seen this a number of times in results in Australian companies as well, right? So the general take for companies during COVID was demand is going to shrink, and therefore they pulled back on orders and pulled back on stuff. But demand actually increased because people had nowhere to spend their money on. So then you got this into a supply chain imbalance. Combine that with factories being closed. There's been a huge imbalance in the supply chain altogether. What Cook is saying is that some of that is starting to resolve, but there's still plenty of demand. There's increasing demand at the high end because of newer chips that are coming, and everybody who's making new chips that's putting demand. There's a capex issue there. And on the other side, there's still, some normalization to go through and some supply chain things to, so he thinks those things will iron out, but not yet. And then the final thing that he's saying was, I think they're saying more demand than they probably expected for some of their recent products, which talks to the strength of just the entire brand and the ecosystem, and a lot of switching happening, probably more than what they expected. And that makes sense. With the M1 series, for example, I can expect a lot of switching happening between, Surface laptops to people coming to Macs. It's just a different experience altogether. And once you're in this ecosystem, then there's there's all sorts of other things that people are going to buy. So those were some of the interesting things I thought, so they're guiding for a really strong quarter, which is still supply chain constrained. So anyways.
I thought that was a really interesting comment that you made there about, Tim was asked on the call about how is the mix of iPhone, the iPhone 13 in particular, is it switches, is it upgraders, what's going on? And he called back to last quarter where he said it was double digits for both. And this quarter, he seems to suggest, this bit early for the 13, but he seems to suggest that it could be the similar mix in terms of people still switching, which is huge, because this is all part of Apple's, the appeal of Apple products, which we've talked about numerous times, is once you are using the iPhone, you're more likely to use the Mac, you're more likely to get the AirPods, and you're in the ecosystem. And then all of a sudden, a couple of years down the track, you're an avid user of the services business too. So this is all just, if we talk about cohort analysis, we talk about, dollar-based net retention, it's a bit harder with a company like Apple, but it is kind of qualitatively, it's there too. We spend more, we upgrade, and then we get the feed in from the switches too. So really fascinating stuff. I thought, as we look out the quarter ahead and the uncertainty, that they reassured us that it's positive, but there is uncertainty. I think it's broadly positive, and I think this update was really strong, even if the shares come off a little bit after hours. So I'm a happy shareholder. Apple is actually one of my biggest personal positions, and I'm quite happy to keep it that way.
Shares are up, I think 30% or so year to date, and they were up like, and my colleague Steve Symington had, and he said, the shares are down maybe 3% in after hours, but they were up 2.5% in the regular days. It's like net, it's not much.
Yeah, it's nothing. Yeah, that's true. I think people tend to think that the market's insight as soon as results are released or something is announced are indicative of how the high quality that announcement was. Not necessarily. We've talked about this before. You've had conversations on this in the past, but when we read the news, we say, Apple failed to beat expectations, or failed to hit analyst targets. But at the end of the day, it's analysts that kind of get it wrong, not the other way around. So something to keep in mind. I think that was a really strong quarter. Okay, so the other one, which I might go through a bit quickly today, is a company that we covered in the past, which is a company called Dubber. It's an Australian company. I'll see if I can bring that up for you just on the screen here so I don't mince my numbers. But Dubber's come out with its quarterly activities report here in Australia. We call that a 4C. So you can see some numbers here that are pretty positive on the screen. But so what does Dubber do? Dubber is a voice recording and intelligence company. So basically they take voice data in, and they turn that into something meaningful. So we gave the example a few months ago of an airline during COVID. All the calls are recorded for quality and assurance purposes. And the employer of the airline could actually assess their frontline workers, because obviously they were getting so many negative calls coming through. Hey, my flight's cancelled. Why haven't I got a refund? And that can take its toll on workplace morale, especially if you're in a distributed workforce. And so that airline could use Dubber's software to basically run sentiment analysis to see how their staff are feeling. And that's a really interesting use case. So Dubber came out today. It's basically said, I've highlighted the things that are interesting for me, but they've said revenue was up to $8.1 million for the quarter. I don't know why they use brackets around increased by and then brackets 700K. Whenever I see brackets in accounting, I think negative. So it just threw me a little bit, but they said the subscribers now exceed 450,000. So that can be a subscriber through an enterprise. It can be a subscriber through, like, say, if you use Telstra and you want voice recording on your device, you could be a subscriber. One of the big things that Dubber's been pushing with recently is basically forging deals that enable it to kind of unlock multiples of its current addressable market in one stroke. So what I mean by that is they partner with the telco to bring cloud voice recording to that. Another thing that they've done recently is partnered with Cisco's WebEx and basically made it as a default voice recording package in Cisco WebEx. And you can get it in Zoom. We're using Zoom right now as in the marketplace for Zoom as well. So you can use Dubber to record calls and transcribe calls and use all that dashboard in the cloud. So there's a fair bit to go on here. I think one of the things that I might say, I own shares in Dubber, but one of the things that I might say as just a word of caution is that the companies like to talk about organic growth. And we as analysts and investors typically say, oh yeah, they made an acquisition this year, therefore we'll exclude that, but then everything else is organic growth. If they made an acquisition last year, that can still be acquired growth. And so, yes, you might exclude one acquisition. They've made one acquisition here, a small one, but keep in mind that even if they're growing fast this year, that could be the result of the acquisition in the last quarter of last year, for example. And so that's not necessarily organic growth. And so one of the things that I'm struggling to reconcile with Dubber is how fast is its actual underlying call recording business growing? We can see some charts here that show pretty promising signs going bottom left to top right, but I mean, don't they all? So I just wanted to put that out there as kind of an air of skepticism. The company has $126 million of cash in the bank. Keep in mind, they like to make acquisitions, and they just did a $110 million cap raise, and cash is going out the door currently while they scale. So some things to keep in mind. That's ASX, DUB, Dubber operates in voice recording. So I don't know if you've had a look at this company or you know it that well, but like I said, it's an interesting kind of a higher risk investment.
I know of this company and I've looked at it in the past. I haven't looked at this 4C, but I think you covered everything. So there's nothing more for me to add.
Cool. That's easy then. We can move on. I might throw it over to you, mate. Amazon. I actually haven't had a look at the report yet. So tell us a little bit about what Amazon reported.
Yeah, so I think Amazon. I'm just trying to get the Amazon's report. The slides up.
Amazon, I feel like I've heard of this company before.
So I think the main thing that is worth keeping in mind on, keeping an eye on, was the net sales were up a bit, 15%, which is not bad for that scale, but their guidance forward was a bit weak, which is something to keep an eye on. And again, that sort of technically makes sense. So there's, if you think about all the supply chain issues, production issues, combine that with people, shifting some of that online buying that they were doing back to physical retail, or maybe just going traveling or doing other things, it makes sense. It doesn't take away anything. There's a bit of, and of course, e-commerce is heavily competitive as well. My main takeaway is I always pay a lot of attention to their AWS numbers.
Yeah.
And the AWS sales were actually, there was a bit of acceleration there. I think last quarter was like 38% growth. This time it was like 39% growth. And so this is the AWS net sales, or revenue, was 16.1 billion. And that's a very, very large number in one quarter, and that's still growing. It's just a tad under 40%, right? And now we've seen higher growth numbers from people like Alphabet, who reported like something like 5 billion for their cloud unit, but that's and they said 47% or something like that growth for GCP, but they don't break out Google Cloud Computing or Google Cloud Platform. But let's say it's 80% of that total cloud package, right? I mean, that's a significantly smaller business growing a little bit faster than these guys, but I think a lot of credit is due here. And I think a similarly high number was, something around between 40 and 50% was quoted by Microsoft. Again, they don't give you the exact sales figure for their Azure side, but again, that's fast growing. So my guess is Azure is number two, probably somewhere around half of the size of AWS, and this one is probably a quarter of the size. The GCP is, the Google Cloud Platforms, 1/4 of the size of Amazon. So Amazon should get a lot of credit for how it is tackling the competition, increased competition in cloud, and it's doing really well. So so as usual, I think e-commerce has got a long tailwind behind it, so they'll be just fine over time. We shouldn't expect very high growth numbers anyways from a retail business. It's also a low margin business, but I think this side of the business is doing really well.
Yeah, it's those numbers, I'm just looking at them now. Basically, operating income looks like it's a margin of around about 25% on AWS alone. And if it's growing so fast and as it scales, it's just a vicious business. And it's starkly in contrast to the kind of e-commerce business that we know. It's really low margin, not really, I mean, it is recurring, but it's a different type of business model. Whereas AWS is, fruitful, and a long way to go from the TAM estimates that I've seen around the traps is anything to go by. The massive shift to the cloud is still in full effect. We are still in that S curve. Fascinating results, mate. I think I think it's a really interesting business. Do you own shares in Amazon? I don't.
I do. I have shares in Amazon and Apple.
Apple, yeah. There's one more company that we'll talk about in just a moment, which I do own shares in. But there was a really interesting thing here in Australia, which I might call out, which is a company called Vulcan Energy, which is a geothermal company. I first came across actually about 2 weeks ago when I was asked to go on the tally and talk about a few companies, and one of those companies was Vulcan, and it's a geothermal energy company with a project in Germany. And I think one of the big selling points is that there are some pretty serious kind of backers of the company, and so the company went into a trading halt this week, and you can see an article here on our website by Lachlan. And basically, Jcap, which is a short-selling company, has come out and said, we think management's estimates of Vulcan Energy's business model is actually a lot lower. It's materially. So management have said the project is worth so much money over in Germany, and it's going to get off the ground in a few years, but bear with us because it will be really high margin extraction, really good flow rates, et cetera, et cetera. And Jcap's come out and said, well, everyone else in nearby, all the other competitors nearby don't achieve those rates of growth, and they don't achieve those flow rates for the geothermal plants. So how can you make that assessment? And that's basically been challenged, and the company's gone straight into a trading halt. And you can see here that, over the past year or so, the company has just accelerated in terms of share price. So let's take from, this is a bit longer back, let's say the beginning of, say, 2020, 15 cents a share, the company's now $15 a share. So you can do the math there. There's been some very wealthy investors out of this one. But what's important to note is, by my numbers, most recently, the company had a market cap of around about 1.6 billion Aussie, and I don't think it was really any revenue at all. So this is still a business. So $1.86 billion market cap and effectively no revenue. That's what's written here on Mass Media. So this is a business that is another kind of target of a short attack. Oh, I shouldn't say short attack. It's not a short attack. It's a short report. And basically, they've come out and said, listen, your project, it might be good, but it's still a long way off, and it's probably not as good as you suggest it is. And given your valuation is this high, maybe it's, maybe this is not a good thing for investors, and maybe investors should cool off a bit, is effectively the rhetoric. Typically what happens in the case of a short report is the company releases an announcement to discredit the short report. And it seems that kind of has happened here, basically pointed out that maybe the shorters don't have the experience in the industry. No, I'm just kind of paraphrasing what I interpreted the ASX announcement to mean. The company has, I believe, now come out of its trading halt this morning. I'm just going to double check that. And it looks like it's come out this morning and fallen about 14%. So maybe it was just enough to spook some investors. Maybe it was, I don't know, maybe there was a little bit of the truth in there. Maybe there's, who knows who's telling the truth. I think when you're an investor in this type of situation and you're in such a richly valued company and a short report comes out, you often feel out of your depth. You often feel a bit like, what is actually going to happen? I hate short selling. I hate, what are they representing? Who are they acting for? And all this type of stuff. And it can be really hard if management are a bit cagey. I think the best thing to do is for management to front up and try and rebuff the short report. We've seen that in the past with Rural Funds Group. They did that pretty well. Credit Corp did it here in Australia pretty well. And some of the others haven't done it so well. So yeah, I don't know what happens next with Vulcan Energy. I'm just kind of paraphrasing what I've interpreted the situation to be. It's not a company I'm invested in, nor would I want to be invested in, because it's not, it's not free cash flow positive, all these types of things. So I just say, we'll see, play it out. We'll just see this one play out from a distance. I don't know. I don't think you'd follow this type of company very closely. A geothermal company listed in Australia, operating in Germany. Yeah.
Not my type. I'm familiar with the name Jcap. They had shorted WiseTech as well.
Yeah, they did.
Yeah, but usually what happens in this, I shouldn't say shorted. They had a short report, and usually what happens is there's a short report, there's a response, and there's typically another report that would follow based on the responses of the company. It's almost like responding to something like this basically means that you're going to get into a series of back and forths, right? And it plays out in public. Yeah, I don't have anything to add really about this. I don't know much about it. So
yeah, that's fair enough. And I think, yeah, the court of investor opinion is often a volatile one if you're in the middle of it all. So, and you've got to remember that oftentimes there are super powerful incentives on both sides of this debate. So it's not like they're going to come out and go, oh, actually, you know what, you were right. So they're going to come out and say that, because if they did, there'd be trouble. So it's a really interesting, I guess, state of affairs that investors find themselves in. I think the best thing to do is just remember why you own your investment. And, if you believe management are being forthright, then that's your interpretation of the situation, and fair enough too. Okay, so we've got two companies that we'll try and get through here at the end. One of them is Alphabet, which is obviously a company that went through a name change quite a little while ago, and released its third quarter report this week, mate. So we know Alphabet being the parent company of Google, and a heap of other things under the hood. What did you make of the report?
Oh, let's make this quick. The report was fantastic. So again, revenue grew 39% year over year for the quarter. And this is actually something to remember here is what happened is that they had a relatively easier compare, because unlike exceeding demand for consumer electronics and things like that, and furniture and lounges, actually ads slowed down remarkably during the COVID crisis. So the prior year they only grew about 14-15%, which for this size of the company is perfect, right? I mean, 20% growth, 15, 8, somewhere in that teens is pretty good. But one of the magics that we see, or this is how it works in this sort of business, is there's a lot of operating leverage, right? So the operating margin went from 24% in the prior year to 32% this year because of the significant growth. So it delivered 65 billion in revenue in this quarter. That's some fabulous. And the earnings per share diluted went from 16.4 a year ago, that is dollars, to 27.99. I wish they just rounded up to 28, but out of honesty, everything we talked about the GCP already. I think they're doing a great job there, trying to sort of solidify the third place position behind AWS and Azure. The only thing, I guess, the most surprising thing for me was there are 50 million YouTube premium music subscribers. I would have never guessed. 50 million people actually pay for this thing, which is basically free. You're just going to tolerate some ads that you don't want. But 50 million people do pay for it, which I was surprised. That was my little takeaway from their results. I thought it was great.
Well, Apple came out with the MacBook Pros, and I think we talked about this previously. They did something similar with I mean, they've always had music and iTunes and whatever, but they brought out that kind of voice only, like Siri only music subscription. And we know Spotify obviously is a massive player in the space too. So yeah, I have a YouTube premium subscription, and basically what that gets me is no ads. And it also gets me the original series. Not that I ever watched, I don't think I've ever watched anything on it, but if I wanted to, I could get some originals, kind of like a Netflix, but it's aimed at younger people, I think, on YouTube. I think there are a few things that are worth calling out here. The first is that basically Google is going across verticals and zeroing in on the verticals where it sees that it can kind of get deeper into that ecosystem. So what I mean by that is, we saw that with travel a few years ago. Instead of when you go into search results and you have to go to the booking.com or wherever you go to book your flights and your hotels, you can now do that in the search engine itself. And so I think that's a really powerful thing too. And as that moves across more verticals, like tourism, for example, they had one where emerging as we reopen, you can actually book activities in the physical world to do through the Google search engine. And obviously things like Google Pay, I think they came out and said, well, I think this is a bit up in the air at the moment, the Google Pay side of things. They did come out and say, I think off the top of my head, is around about 140, 150 million people were transacting on that. So that's a big thing too. We talk about Apple Pay and all those types of things, and the wallets and the like, but that's a meaningful business under the hood as well. And finally, we've seen, I think it was Freshworks, we saw Toast, and other companies IPO basically out of Facebook's either venture arm or its incubation arms, and those are really interesting things. And there was the interesting race to do drone delivery. I don't know how this is going to play out. I've never had a drone delivery myself, but imagine drone delivery from Walgreens in the US. We had it here in Canberra as well, and I think it was in Logan, either them or Amazon. So drone delivery is already in play. It's already in motion. Drones are delivering things like cooked chickens, for example, is what one of the videos that I watched. It showed a chook being delivered from a local shop to someone in lockdown via drone. So fascinating stuff. You can even get your coffee. So yeah, Google's Alphabet is a business that I own, and I really like it. So yeah, I like the quarter. I thought it was really impressive, and I was kind of blown away by how strong it was, to be honest. I thought it'd be more impacted by iOS changes, but the scale of it, they said it was kind of negligible. So fascinating stuff. One final company if I may sneak this in, which is a company called A2 Milk. So A2 Milk is the Australian business that, makes A2 milk. It's good for your tummy, apparently. And we've talked about this in the past, and this is a running joke. For those of you that are new to the podcast, this is a running joke. Maybe we can just have a look at, I'll share my screen with you and we can have a look at this, mate. But I don't know if it's good for me or good for you in terms of our wager. But if we look at, say, A2 Milk over the past few years, in terms of the share price, that's fallen very heavily.
I'm winning.
So that's fallen a long way. And then if we look at, say, Treasury Wines, which was my wine, it's kind of come back, but it's fallen off a little bit as well. So basically the idea was that if Treasury Wines gets a takeover offer, I think you were going to be buying me a wine. If A2 Milk gets taken over, I was going to buy you some milk. I think that was the deal. But what was really interesting is A2 Milk came out this week and basically said that they basically come out with this report on themselves, which to me kind of looked like a brokerage report. It was 163 page slide presentation. And basically what they've said is they've come out with ambitious forecasts, which if you look at the medium term forecasts, they're actually lower than what they were pre-COVID. So what they're saying is in the future, we're going to get back to a point which is below what we were a few years ago. And there's been a lot of change since COVID, and in the mix with the Daigou route into China and all that type of stuff. And also the margins are going to come under pressure. They were previously achieving 30% EBITDA margins, and they're forecasting now margins closer to, I think, 20s and the 20%. So in that range, basically A2 Milk is under pressure. And based on forward estimates, even still, then it's a little bit hard to get to, not hard to get to the valuation today, but if what management is saying is actually what they deliver, I think you would still struggle to get to the valuation today, if that makes sense. So if that's optimistic, you might be left with kind of an underperforming business in your portfolio over the next few years. So it's just a really tough thing we've talked about in the past. But I mean, hey, if that gets taken over for its brand, it's got a pretty strong brand. Fresh milk is still being sold. Who knows? It could be a little treat arriving for you in the mail.
Yeah, and then they could, create an non-fungible token for the milk and then sell that for gazillion bucks. So maybe there's a business there.
Easy, just like that. So watch this space. Mate, we've had a lot to talk about today, and it's been heaps of fun. It's always good when there's news and there's heaps of questions. We got a heap of stuff coming through on Twitter. People saying, take a look at PointsBet, eRoad, Volpara, Damstra, so many companies. Tesla, obviously, we talk about Tesla a lot, so we probably can't talk about that every week. But Shopify would be a company that we could get to. If you want to find us, remember that you can find us on Twitter. The easiest way to find us is at 7A Mahanti. So you can find Anirban on Twitter. You can find me on Twitter at Owen Rask. That's Owen R-A-S-K. You can find us there, and we'll just have a chat with you if you want to jump on there. I'm going to give a special shout out though. We're almost at November 1st, which means the 7 investing team are coming out with recommendations, getting a bunch of new recs, including one from yourself, which by the sounds of it could be a bit, could be interesting, so to speak. So where can people go to find out how they can get their hands on these recommendations?
Just go to 7investing.com/subscribe and use the Rask code if you want to get a discount. Yeah. And as you said, we are on Twitter. Talk to us. Chat with us.
Yeah. I think the 7 investing team on Twitter is super engaged. I don't think I've seen an investing team so engaged on Twitter before. So it's really impressive, and you've all got great followings, which it's even more impressive that you respond to everyone and you actually have such a good engagement with them. So yeah, you can find the 7 Investing team on Twitter, 7investing.com/subscribe. If you want to find out more about what we're doing here at Rask, you can head to www.rask.com.au. We have a bunch of free courses. I'm super proud of this, mate. We've got about 11,000. We've enrolled around 11,000 students into our courses. So I'm very happy with
brilliant. That is brilliant.
Yeah. And we do most of this, for those of you that don't know, we do it, almost all of it for free. So it's all basic stuff, and there's some intermediate stuff in there as well for investing. But yeah, check those out if you want something to do over your weekend. Mate, it's always a pleasure to chat. So thanks for taking the time out for joining me. And thanks to any listeners that tuned in live on YouTube. Always a pleasure, mate.
Always a pleasure.
And that's a wrap. I will just end this stream. Thank you, everyone, for tuning in.
Oh, thank you.
There we go. Cool.
Great.